Welcome back, students who are taking financial accounting. And as we've gone through these videos, we're on part number 7 here, and we still haven't even gotten into the textbook, but that's just the nature of things. So let me briefly recap where we're at. Let me jump down to the slide. All right. And just as an FYI, if you don't understand something, feel free to pause and rewind and watch the videos again. And if you still don't understand something, feel free to contact an instructor. Okay, so as a quick recap before we move on here, we push on. All businesses have let me get my pen. All businesses have a general ledger. Okay, that's the books of accounting, is the general ledger. And in that general ledger, you have general ledger accounts. Okay, and they're categorized by assets, liabilities, equity, revenue, and expense accounts. Okay. And the accounts, all assets begin with the account number 1, liabilities begin with a 2, equity begins with a 3, revenue begins with a 4, and expenses begin with a 5, regardless of how many digits in that ledger account number. Now, all of these accounts are found on a chart of accounts, which is nothing more than like a table of contents. Okay. And if you take the chart of accounts and you show the balances in the general ledger accounts, okay, you have what's called a trial balance. And the trial balance is when you, it's as of a specific date, okay? Whatever date you run it on. It doesn't, if you're like today happens to be July 6th. So as of July 6th, 2015, whatever the balances in those general ledger accounts are, as I'm running that particular trial balance, those are the balances as of that date. You can go back. I mean, if you have a computer system, you can go back and choose any other date that you want, because the computer system has the ability to parse the information and allows you to be able to see, like I said, at a specific point in time. Okay. So now, how does the information get into the general ledger accounts? Well, all businesses have a journal, and every business has a general journal. Okay. So what happens is a transaction occurs, and from that transaction you have documentation. Those are that's your original documentation. That's the backup that shows you exactly what happened in that transaction. And that transaction is put into a journal. And of course, every business starts with a general journal. So when the information is put into the journal, you create what's called a journal entry. And all journal entries, and I realize that you don't know what a debit is and a credit is just yet, because we haven't covered the information in the book, but just take it for granted. And remember, what we're doing here is we're trying to just create a framework, give you some idea as to what you're going to be looking at going into the future. So every journal entry, we have debits must equal the credits. That's an inviolate rule. Okay, debits must always equal the credits, and throughout your entire set of books. That's what double entry bookkeeping is all about. That's how, due to that system, you can't embezzle anything. All right, somebody's always going to find embezzlement. If there's if your debits don't equal your credits, and that's what keeps the system honest and fair. When you had companies like Qualcomm and Enron, they were cooking the books. They weren't following that set of rules, and eventually it just catches up with them. So every business has a general journal, and all transactions could be put into the general journal, and that means if you wanted to, you can have just one journal. But if you're having 1,000 transactions every single day or 100 transactions every single day, it makes no sense to have just one journal, because that journal gets so large it becomes difficult to look up information, do research, and so on and so forth. So what ends up happening is you create special journals. And special journals are nothing more than creating additional journals with different names. A journal is a journal, regardless of its name. When transactions are created, they're put into the journals, and then those transactions are posted to the general ledger accounts, but I'm getting just a little ahead here. So special journals are nothing more than any old journal with special names. In this case here, common ones are cash receipts, cash disbursements, and payroll journals. So you can put, even if you make a mistake, what you're trying to do is you're trying to group like transactions together. Meaning, instead of having 100 pages in a general journal, well, any payroll entries I want to put into a payroll journal. Any cash receipts, meaning whenever I receive cash, I'm going to put it into the cash receipt journal. If I'm paying cash out, I'm going to put it in the cash disbursements journal. And then any other entries that don't go into those three journals would, I'd eventually put it into the general journal. Now, you can create as many journals as you want, okay? Think about companies like Microsoft. They have businesses in every single state, right? Well, for payroll, they're not just going to have one payroll journal because they have thousands of employees. A company that has 30,000 employees, why have just one payroll journal, right? No, they probably have a payroll journal that's subdivided by state, by county, by city, okay? Or by location or whatever have you. So you can create as many journals as you want and name them whatever way you want. And the reason why you're doing that is so that you're grouping like information together, and it's up to you to decide how that happens. But a journal entry is a journal entry, and when it gets put into to a journal, at the end of an accounting period, everything has to be posted into those general ledger accounts. Okay, and so the information gets put into the general ledger accounts, and when we add up the balances in those accounts, we create ourselves a trial balance. And again, the trial balance is nothing more than a listing of the accounts and the balances in those accounts. So that's a brief summary as to what we covered in the last few videos. So let's just move on to the next slide and see what happens with that information. Okay, so now we have all of this information in our general ledger accounts. Okay. Oh, and just as a quick aside, what we're doing with the journals, okay, is we're just rearranging the information, by the way, okay? All of the information is in the journals, and then we're putting it into the ledger accounts. So all we're doing is just rearranging the information and grouping like transactions together, okay? Meaning anything that affects cash goes into the cash account. Anything that affects accounts receivable goes into an accounts receivable account or a payable account. So that's all we're doing, is just rearranging the information in the general ledger accounts. So now, what do we do with that information when we have the balances in those accounts? Okay. Well, every out of those balances in the general ledger accounts, every business has a balance sheet and an income statement. That's a given. Okay. You can't have one without the other. All right. And without getting into too much detail, all right, the balance sheet shows the financial position of the company at as of a specific date. Right? Now that's the financial position of the company as of a specific date. The income statement is for operations. Okay, it shows your profit or your loss for a period of time. Okay, and the thing about the relationship, and we'll see this later on, um, is that the income, whatever profit or loss that we have on the income statement, it gets transferred over to the equity section, UITY, equity section of the balance sheet. Okay, so there's a relationship between these two financial statements, right? And between the both of them, we can start to do analysis for, of the business, right? So remember, a bookkeeper does the data entry, but the accountant goes and makes sure that that data is entered correctly, and then the accountant creates the balance sheet and the income statement, and allows accountants to start to do analysis on the business in whatever manner is necessary. Now the question becomes, is there only the two financial statements that are created? Well, not really. A couple of more common financial statements are a statement of cash flows, which strictly looks at how cash is flowing throughout the business. And there's also a statement of retained earnings. Now, I'm going to talk about the retained earnings first, but most businesses will create obviously they have to have the balance sheet, they'll have the income statement, and the next statement that they will want to create would be a statement of cash flows, with the statement of retained earnings being fourth. And what the statement of retained earnings is, on the balance sheet, in the equity section, they summarize the information, and the statement of retained earnings shows the detail of the equity section on the balance sheet. Now remember, the profit or loss from the income statement goes on the equity section of the balance sheet also. Okay, so the income statement is tied to the balance sheet, but the information there can get to be kind of unwieldy at times. Okay, so it would be summarized, and that summary, if we need it, we create a statement of retained earnings which shows us that detail. Okay, now the statement of cash flows is all, when a business first gets started, they have a choice. They can either choose to operate on a cash basis, which means they record all of their transactions whenever cash is affected. Okay, or it can be done on an accrual basis. Okay, which means it's not affected by cash. To give an example, if I went to Home Depot and I bought supplies using cash, okay, if I was operating on a cash basis, well then I would record that entry when I actually purchase it and I paid cash. If I'm using the accrual basis, I can do the same exact thing. In other words, I could go to Home Depot and purchase it using, cash or a check, and I would record that entry. However, the cash basis restricts the flow of business. For example, I want to go to Home Depot, but I don't have the money to buy the tools or the supplies. If I'm a contractor, okay, construction contractor, and I need to buy all kinds of materials in order to do, say, a roofing job or a remodeling job in a home. Well, the owner probably still hasn't paid me, and I don't want to dip out of my pocket for the cash. So I go to Home Depot and I buy the supplies on credit. Okay, so when I buy the supplies on credit, what I'm doing is I'm using the accrual basis of accounting, meaning I'm recording the transaction because I'm getting the supplies, and of course that's going to create an accounts payable for me. I haven't paid cash just yet. But then sometime in the future, when I do pay off the accounts payable, I'll end up using cash. Okay, so the accrual basis facilitates business because now I'm able to operate. I could go to Home Depot, they're providing the credit. Because I'm credit worthy, I get the supplies, I can, do the remodeling job. The owner pays me, I pay Home Depot, and all is good. And I'm in my books, and that might happen. Let's say that happens over a 3-month basis, a 3-month period. Okay. Um, if I was using the cash basis, all right, well, technically, I would only pay for the supplies when I would only record the purchase of the supplies when I paid the cash for it. Okay, which isn't the way the transactions occurred. The transactions occurred over a 3-month period, and it's not as realistic. However, why do I have a statement of cash flow? Because cash is king. Okay, if you don't have cash in a business, if you don't have enough cash to pay your vendors, you don't have, or you don't have enough cash coming in from your customers. What about financing? Things like this. We have to be able to pay attention to how our cash is flowing, because if I run out of cash someplace along the line, I get squeezed. All right, if I don't have enough cash to pay my bills and my mortgage, I'm in trouble. So creating a statement of cash flows is an important part of um, your financial statements. Small businesses have a tendency not to create statement of cash flows, but larger businesses always do, because they need to know where the cash is coming and going to. Okay. All right. So with that said, I'm going to stop here, and I'm going to have probably one more video here about the overall. Even though we saw how transactions occur, information is put into the journals. The journals get posted to the general ledger accounts, which is nothing more than rearranging the information. And once we've rearranged the information, we're able to create, these here financial statements so that we could do reports and we could do analysis. There is a process to this, and that's what we'll cover in the next video. So again, wait until you see the next video. But if you still have questions, watch the videos again, and if you still don't understand something, feel free to call and speak with an instructor. But realize that you really need to get a broad understanding, watch everything at first, and then have the pieces fit together. This here is just to be able to prep your mind for what's coming. Okay? See you in the next video.